Let me ask you something that nobody on financial television will say out loud. What if the dollar isn't just weakening? What if the entire framework you were taught to build wealth inside of is structurally obsolete? Not broken, not struggling, obsolete. And here is what makes that so dangerous. Most people will not find out until it is already too late to reposition. By the time you finish this video, you will have a complete architectural framework for building a portfolio that does not depend on the dollar's survival. One built around the asset class that sovereign wealth funds and the world's most sophisticated family offices are quietly accumulating right now. You will understand what I call the three-tier digital treasury, how to generate yield from compute infrastructure, and exactly how to execute the migration in 3 stages without blowing up what you've already built. That is the blueprint. Let's build it. Here is what I mean by obsolete. For the last 70 years, the dominant logic of wealth building has been anchored to one assumption, that the United States dollar is the irreplaceable center of the global financial universe. And wrapped around that assumption was an entire belief system. Diversify across asset classes, hold bonds as ballast, trust the 60-40 portfolio, keep cash liquid, let compound interest work over 30 years. That logic made sense when dollar supremacy was unchallenged, when petrodollars were the language of international trade, when the gold window mattered, then when it didn't, and the dollar filled the vacuum anyway. But something changed, something structural, and it did not happen overnight. It happened in layers, and by the time most people noticed, the foundations had already shifted beneath their feet. In 2025, we watched the sovereign debt crisis expose something most economists refuse to model. Traditional currency hedges did not protect wealth the way they were supposed to. Gold held, yes, but the broader system of dollar-correlated assets moved in ways that surprised people who thought they were protected. Here's the number that should concern every serious architect in this audience. The institutions that positioned early in compute infrastructure in 2023 and 2024 are sitting on structural advantages that dollar-correlated portfolios simply cannot replicate. Not because they were lucky, because they understood what was replacing the old system before the old system admitted it was being replaced. And here is what replaced it. Quietly, systematically, at the institutional level, before most retail investors were even having the conversation. Compute, processing power, the physical infrastructure of artificial intelligence. Because the new measurement of national power, the new store of value, is not barrels of oil or tons of gold. It is terawatt-hours of energy directed at GPU clusters. It is sovereign AI capability. It is the capacity to process, train, and deploy intelligence at scale. Pause. We're not talking about buying tech stocks. We're talking about something far more fundamental, a restructuring of what value means at the civilizational level. And if you're serious about building wealth that survives the next decade, not just preserves itself, but compounds, then you need to understand this shift from the architecture up. At Wealth Forge, we don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom. That is not a tagline. That is a methodology. And today, that methodology is going to walk you through exactly how to design a portfolio built for the post-USD world, one structured around what I call compute hegemony, the principle that processing power has become the new sovereign reserve standard. Stay with me, because what we are about to build together is not a theory, it is a blueprint. The twilight of fiat and the rise of the Silicon Standard. Let's start where the story actually begins, not in Washington, not on Wall Street, but in the data centers of Riyadh, Beijing, and Texas. The 2025 sovereign debt crisis was a warning that most people misread as a recovery story.
Yes, markets stabilized. Yes, certain hedges performed. But the underlying mechanism, the reason the crisis emerged in the first place, was something that has been building since at least 2017. When nations began losing faith in one another's fiscal discipline, the traditional move was to flight into the dollar. That playbook worked for decades. But here's what happened differently in 2025. The flight to quality move did not universally reward dollar-denominated positions the way the models predicted. Why? Because confidence in the dollar itself is no longer operating outside of scrutiny. The United States federal debt is now at a level where servicing that debt consumes a structurally significant portion of tax revenue. That is not a partisan statement. It is a mathematical observation, and markets are not stupid. They are beginning to price in the long-term structural risk of a reserve currency whose issuer is also its most leveraged participant. So where did capital go? And more importantly, where is capital being designed to go? Here is where the petrodollar pivot becomes critical to understand. From roughly 1973 onward, the global financial system operated on a simple, elegant bargain. Oil would be priced in dollars, which meant every nation on Earth that needed energy had to hold dollars, which sustained dollar demand regardless of American fiscal behavior. That was the invisible architecture of dollar supremacy. But the energy transition, and more critically, the artificial intelligence race, has introduced a new numeraire, a new thing that nations and corporations and sovereign wealth funds must acquire no matter what. And that thing is not oil, it is compute. Think about what training a frontier AI model requires. Tens of thousands of high-performance GPUs, enormous energy infrastructure, cooling systems, physical real estate, global logistics chains. When you add it all together, the countries and entities that control sovereign compute capacity are the ones setting the terms of the next economic era. This is what I call the Silicon Standard. Just as gold once backed currency and then oil backed dollar demand, advanced computing infrastructure is becoming the new anchor of sovereign economic credibility. And the architects who understand this are not waiting for CNBC to announce it. They are building positions right now. Here is the loss aversion frame I want you to sit with for a moment. The question is not whether the transition from petrodollars to the Silicon Standard will happen. The institutional capital flows confirm it is already happening. The question is only whether you are positioned before the mainstream realization or after it. Every previous major asset revaluation in history has rewarded the early architects and punished the late majority. The mechanism does not change, only the asset class does. The metric that matters is no longer GDP growth rates or trade deficit ratios. The metric that matters is GPU hours per capita. It is AI training capacity as a percentage of national industrial output. It is whether a country's sovereign wealth fund has meaningful allocation to the physical layer of global intelligence.
Because the countries that control the compute win the next 50 years, and the individuals who understand that, the ones building portfolio architecture aligned with this transition, are the architects of a genuinely different financial future. The architecture of a compute-centric portfolio. Now, let's get structural, because this is where philosophy becomes practice. I want to give you a framework for thinking about what I call the three-tier digital treasury. This is the conceptual architecture for how to build meaningful exposure to the compute economy without simply speculating on individual stocks or tokens. The first tier is raw hardware equity. This is the physical layer, the companies manufacturing and deploying the actual silicon, the energy infrastructure feeding it, the cooling and real estate surrounding it. This is not purely a tech sector allocation. This is an industrial allocation. Think of it the way you would think about owning railroad companies during the industrial expansion of the 19th century. The value was not in any single train. The value was in the capacity to move things at scale. Raw hardware equity includes companies with meaningful GPU manufacturing moats, energy companies with dedicated AI infrastructure contracts, and industrial REITs specializing in data center construction and operation. This tier has volatility, but it also has physical asset backing. You can value it, you could audit it. There are real buildings with real cooling systems and real machines inside them. The second tier is decentralized compute protocols. This is where it gets more nuanced and where the architects separate from the speculators. There's a category of blockchain-based infrastructure that is not about digital currency speculation. It is about creating open markets for computing power. The concept here is called proof of useful work, as opposed to the energy-intensive but economically inefficient proof-of-work systems you might already be familiar with. In a proof of useful work system, participants contribute actual computational labor, AI training jobs, protein folding simulations, cryptographic operations, and receive compensation in proportion to the useful work performed. Pause. This matters because it means you can participate in the compute economy as a capital allocator without being a hardware operator yourself. You are essentially providing liquidity to a decentralized infrastructure market. The risk profile is meaningfully different from traditional crypto speculation, though it is not without risk, and anyone telling you otherwise is not being straight with you. The key differentiator to evaluate here is the actual utility demand. Is there real commercial demand for the compute this protocol provides? Are there enterprise contracts? Is there a supply-demand dynamic driven by genuine AI workloads, or is it purely speculative token economics? That distinction is everything. The third tier is algorithmic liquidity, the instruments that allow you to move between compute exposure, traditional assets, and cash positions with sufficient speed to capitalize on volatility rather than being victimized by it. This includes liquid alt strategies, volatility products structured around AI infrastructure indices, and carefully selected option strategies that hedge your hardware equity exposure during regulatory shock events. Now, the risk profile of these three tiers is not equal, and it should not be weighted equally. For most architects thinking about a post-USD positioning strategy, the rough weighting should skew toward hardware equity, the most auditable, most asset-backed, most institutionally legible tier. The decentralized compute protocols deserve meaningful allocation, but also meaningful risk management, and the algorithmic liquidity tier is a tool, not a core position. Here's something that most portfolio discussions miss entirely: geographic redundancy. When you're building exposure to sovereign AI clouds, and there are now meaningfully distinct AI infrastructure ecosystems in the United States, Europe, the Middle East, and East Asia, you need to think about regulatory seizure risk the same way you would think about political risk in emerging market investing. A regulatory shock in one jurisdiction should not destroy your entire compute allocation. That means intentional diversification not just across asset classes, but across the sovereign compute ecosystems that are emerging as distinct nodes of the new Silicon Standard. The architect does not just ask, "What do I own?" The architect asks, "Where does it live? Who controls the legal framework around it? And what is my exposure if that framework changes overnight?" If you're finding this framework useful and you haven't yet subscribed to WealthForge, this is the moment to do it. What we build here every week is not commentary on the markets. It is the architecture the markets have not priced yet. Transitioning from liquid cash to liquid intelligence. Let me talk about yield, because this is the practical question that most people arrive at once they understand the thesis. If compute is the new reserve asset, how do you generate income from it? The traditional answer was interest on cash, dividends on equity, coupon payments on bonds. Those mechanisms still exist, but there's an emerging layer of yield generation that functions fundamentally differently, and understanding it is part of what separates the architects from the observers. I want to give you what I call the yield architecture stack. 3 distinct yield income mechanisms layered in order of risk and liquidity, so you can build a yield profile that matches your actual risk tolerance rather than forcing a single instrument to do things it was not designed for.
The first layer of the yield architecture stack is infrastructure leasing yield. The most direct mechanism is staking capital into AI training infrastructure. Large AI companies need enormous amounts of compute for specific windows of time, model training runs that might last days or weeks and require massive parallel processing capacity. Rather than owning all of that infrastructure themselves, some are beginning to structure arrangements with private capital providers who essentially lease capacity on a guaranteed basis. The yield in these arrangements is increasingly being denominated not in dollars, but in native compute credits, essentially pre-purchased access to AI processing capacity. If you believe that the value of AI compute will appreciate relative to fiat currency, being paid in compute credits is not just a yield mechanism, it's a long position on the most important commodity of the next decade. Slow down. The second layer is real asset income from data center REITs. This is where a lot of established wealth can find a natural bridge from the old world to the new. Traditional residential and commercial real estate faces structural headwinds from a combination of demographic change, remote work normalization, and in certain markets, genuinely unsustainable pricing relative to income. I'm not making a call that the real estate market collapses. I'm observing that the risk-adjusted return profile of traditional real estate is increasingly challenged.
What is not challenged, what is experiencing the most capital investment of any real asset category in the current environment is data center infrastructure. The REITs that own, operate, and lease data center capacity to AI companies, cloud providers, and sovereign technology programs are experiencing demand that in many cases exceeds available supply. These are income-generating real assets with physical locations, physical equipment, and long-term lease contracts with some of the most credit-worthy tenants in the global economy. The third layer is protocol liquidity yield, participation in decentralized compute markets through staking and liquidity provision. This carries the highest risk and demands the most active management, but for architects with the risk tolerance and the technical literacy, it offers exposure to the compute economy at a layer where institutional capital has not yet arrived in force. For the architect who is sitting on traditional real estate exposure and wondering whether rebalancing makes sense, the question is not should I sell my property? The question is what is the marginal dollar of new real estate allocation actually buying me in terms of the portfolio I need for the next 20 years? Here are the 4 key performance indicators for compute infrastructure. Utilization rate. The higher and more stable, the more stable the income. Energy cost structure. Lower cost access creates a durable competitive moat. Geographic distribution of clients. Single jurisdiction client bases carry sovereign regulatory risk. And contract length. Long-term indexed contracts mean reliable compounding. Short-term contracts mean revenue uncertainty. These are the fundamentals of the new industrial real estate. The architects who learn to read them have a meaningful advantage over anyone still applying 20th century frameworks to this category. Managing sovereignty in the age of protocol gold. Here is where we get into the territory that most financial content refuses to address directly. Sovereignty, not as an abstract concept, as a practical portfolio engineering requirement. I want to say something honest to you right now because this section matters more than almost anything else in this video. If you are sitting on meaningful wealth, whether that is a 7-figure portfolio or the beginnings of one, the regulatory environment of the next 3 years is going to be the most consequential threat to preservation you have faced in your investing lifetime. Not a market crash, not inflation, regulatory reach. And the architects who plan for it now will be in an entirely different position from those who plan for it after the fact. Pause. As compute assets grow in value and visibility, they will attract regulatory attention. This is not a conspiracy theory. It is the historical pattern of every previous asset class that generated significant wealth outside of traditional institutional frameworks. Governments tax what they can find. They regulate what threatens existing power structures. They seize what they cannot tax. The architect's response to this is not paranoia. It is engineering. The first layer of sovereign engineering in a compute-centric portfolio is private key management for meaningful digital asset positions. If you hold decentralized compute protocol tokens in an exchange account, you do not actually hold them. You hold a claim on them, a claim that can be frozen, seized, or restricted by regulatory action directed at that exchange.
The technical and custody solutions for self-custody of these assets have matured significantly. For positions that represent meaningful wealth, the friction of self-custody is not optional. The second layer is understanding what I call compute havens, the jurisdictions that are actively engineering their regulatory environments to attract AI infrastructure investment and the capital associated with it. These are not the traditional offshore financial centers. Some of them are major economies that have made strategic decisions to position themselves as the global home for compute capital. The legal architecture for protecting compute-centric wealth across these jurisdictions is complex, jurisdiction-specific, and genuinely requires qualified counsel. What I can tell you is that the structure exists. International holding structures, carefully designed trust arrangements, and domicile diversification strategies can legally insulate your compute stack from single jurisdiction regulatory risk, including the 2026 Global Minimum Wealth Tax frameworks that are beginning to take shape. I want to say something directly here. This is not about tax evasion. Illegal tax avoidance is not a strategy. It is a liability. What this is about is intelligent legal tax efficiency and risk management across sovereign jurisdictions. The difference is enormous, and the architects who understand it structure their affairs accordingly with qualified advisors in advance. The third layer of sovereignty management is something I call a decentralization audit. Not all compute assets are equally censorship resistant. A GPU cluster you own outright in a single jurisdiction is enormously valuable, but also enormously exposed. A position in a genuinely decentralized compute protocol comes with its own risk profile. Traditional data center REITs are auditable and liquid, but fully exposed to both market and regulatory risk. A decentralization audit is a systematic review of your compute exposure that maps each position against three axes. How physically distributed is it? How legally insulated is it from single jurisdiction risk? And how operationally sovereign is it, meaning can it continue to function and generate value even if you, the owner, face regulatory or legal pressure in your home jurisdiction? For most architects, doing this honestly will reveal concentration risks that were not visible when looking at a traditional portfolio summary. The point is not to score perfectly on every axis. The point is to understand where your vulnerabilities are so you can make informed decisions about how much concentration you are actually willing to accept. Executing the final migration and rebalancing strategy. Let's bring this home, because understanding the architecture is one thing, executing the transition is another. The migration from a 20th century paper asset base into a compute-centric architectural stack does not happen in a single transaction. It should not. Anyone telling you to liquidate your traditional positions immediately and rotate entirely into new asset classes is either reckless or selling something. What works, what the patient architects actually do, is a staged rebalancing framework. Let me walk you through the logic. The first stage is audit and map. Before you move a single dollar, you need a complete picture of what you currently hold, where each position sits on the spectrum from legacy fiat correlated to compute aligned, and what the tax consequences of liquidation events would be in your specific jurisdiction. This is the foundation. Skip it, and everything built on top is unstable. The second stage is identify the marginal capital. Rebalancing does not require liquidating everything at once.
It requires redirecting the natural flows of capital that already exists in your portfolio. Maturing bonds, dividend reinvestments, rental income, new savings, toward compute-aligned allocations before they get recycled into legacy positions out of habit. The third stage is systematic scaling into the three tiers we discussed, not all at once, not at market peaks driven by media narratives, with a structured entry cadence that manages volatility exposure and gives you the psychological and analytical space to evaluate what you are buying. Slow down. Now, I want to give you my read on the next 24 months, not as a prediction you should trade on. This is not investment advice, and you should work with qualified advisors before making any allocation decisions, but as a framework for understanding the momentum dynamics of the compute hegemony cycle. We are currently in what I would characterize as the institutional accumulation phase. The sovereign wealth funds, the large family offices, and the most sophisticated corporate treasuries are building meaningful positions in compute infrastructure. This is visible in the capital flows if you know where to look, the data center construction statistics, the energy infrastructure investment commitments, the changes in how certain sovereign wealth funds are categorizing their technology exposure. The retail awareness phase, the moment when this thesis becomes mainstream financial conversation, typically lags institutional accumulation by 18 to 36 months. That window is where the most significant price appreciation has historically occurred in every previous major asset revaluation. The architects who find positioning in this window consistently outperform those who wait for the thesis to become consensus. That pattern has held across every major asset transition of the last century. It will hold here. After the retail awareness phase comes the regulatory response phase. Governments will attempt to tax, regulate, and in some cases, nationalize elements of compute infrastructure. This is not a reason to avoid the sector. It is a reason to have your sovereignty architecture in place before that phase arrives. The architect who moves now, structures correctly, and holds with conviction through the volatility of mainstream adoption is positioned for a genuinely different financial outcome than the observer who waits for certainty before acting. Think about what that actually means in practice. It means a portfolio that generates income in the currency of the next era, compute credits, not just the currency of the last one. It means real assets with real tenants and real demand that no government is going to manufacture away. It means a legal structure that can survive the regulatory storms that are coming because it was built before the storm, not during it. That is wealth that does not just preserve itself. That is wealth that compounds across the conditions that destroy everyone else's. That is what wealth architecture looks like in the post-USD world. That is the moat we are designing. There are two questions I want you to answer in the comments right now. First, are you currently holding any compute infrastructure exposure? Data center REITs, hardware equity, decentralized compute protocols? Or are you still entirely in the legacy asset framework? Tell me exactly where you stand. Second, and this is the debate I want to see below, do you believe the Silicon Standard will fully replace the Petrodollar system within 10 years? Or do you think dollar hegemony has more runway than this thesis suggests? Make the case either way. Because the next video in this series is going to go deeper into the specific due diligence framework for evaluating compute infrastructure REITs, how to read their utilization rates, how to assess their energy cost structure, and how to identify the ones that actually have the sovereign client contracts that matter. That video is already built, and if you're serious about this architecture, if you came this far in this one, you need to see that one next. The architects who find this before the crowd does are the ones who build the moat everyone else eventually wishes they had. I'll see you there.